Hello, I'm Bernard Hickey from interest.co.nz and welcome to the latest economic weather report. Today we've got some very interesting inflation data and surprisingly high producer price inflation data. The big culprit here is higher electricity prices. We've had this drought which has lowered the lake levels and our hydroelectric power is now much more expensive, particularly on the spot market. So what does this all mean? Annual producer price input inflation rose to 7.4% in the March quarter. It was 3.4% on an annual basis in the December quarter. And you can see here from this chart that producer price input inflation has been rising quite sharply over the last 3 or 4 years. Had a dip earlier last year, but has really accelerated back up again. Now let's have a look at output inflation. So this is producers, businesses, and what they're charging for their outputs. This chart here shows quite a significant increase too through 2004, 5 and 6. Bit of a dip in 2007, but it's just blipped up again in March. Annual inflation rose to 6.1%. This is output inflation from 4% in December. Now this was much worse than economists had expected. For the quarter, output inflation was 1.8% when economists had expected 1.3%. Input prices, well, they rose 2.3% when people had expected 1.1%. That's a very big increase. Overall, the key area of concern here is electricity input prices. They rose 41.7% in the quarter. That is stunning. And that's a major cost for business. On the output side, electricity output prices were up 16.4% from the previous quarter, and in the dairy industry, output prices were up 26.6% from a year ago. So what does this all mean for interest rates and the exchange rate? This really is bad news for the Reserve Bank in its fight against inflation. In the last week, expectations had actually grown that the Reserve Bank might be able to cut interest rates reasonably soon, because we had some very weak figures showing that retail sales had dropped sharply and also that the jobs market was dropping sharply. And some economists had expected interest rates to be cut, the official cash rate to be cut as early as September. Previously they thought December. Some were even saying that we could have a rate cut as early as July or maybe even June, which is just 3 weeks or so away. But these numbers have really thrown a spanner in the works. And you can see here from this chart that the Reserve Bank has a real challenge. For 7 of the last 12 quarters, inflation has been above its 1 to 3% target range. So really there is not a lot of wiggle room for the Reserve Bank here. My pick though is that the Reserve Bank will wait until December. That's because it can afford to let the wholesale interest rate markets help and a lower currency help as well. The Reserve Bank needs to help boost the economy by easing monetary conditions. Now, it doesn't necessarily have to use the cash rate to do that. It can use the exchange rate and also the wholesale money markets, where interest rates have been falling in recent weeks and have been passed on in lower mortgage rates. So my pick, a December cut in the official cash rate. That was the Economic Weather Report for interest.co.nz. I'm Bernard Hickey.